Hello and welcome to a CMS Forex Daily Market Recap. I'm your fundamental market analyst, Nick Nassad. Today is Monday, May 17, 2010. We came into this week with the euro continuing to be under pressure, while the EU stabilization package restored liquidity and brought down concerns around funding costs and solvency risks. There are other issues now, including how the eurozone recovery will be affected by austerity measures undertaken by debt-strapped nations within the eurozone. In the Eurozone as a whole, unemployment is running near 10%, and GDP growth in the Eurozone was a modest 0.2% in the first quarter. Also, the measures undertaken by governments can have the effect of declining wages, which could lead to falling prices in goods and assets and create a deflationary situation. There are also concerns that Europe's debt troubles could short-circuit the global economic recovery, which put pressure on equities and oil prices today. With stocks in Asia opening up sharply lower, with the Shanghai main index down 5%, we saw a bout of risk aversion in the Asian session, which pushed the euro-dollar pair down below the 1.23 level, and we actually hit a low at 1.2233, though we did rebound in European trading as European stocks were positive for most of the day. As we entered the New York session, we saw New York stocks dip, which gave us another round of moves in favor of the greenback, though again in the later New York session, we saw the euro rebounding, so despite all the factors aligned against it, the euro managed to hold its own after sliding further to start today's session. We have a couple of important events to look out for on the sovereign debt outlook, including government debt repayments expected from Greece and Portugal later this week, and the fresh issuance of debt expected from fiscally strapped Spain. So that should keep the topic of Eurozone sovereign debt fresh on investors' minds. We may be pausing in the slide in the euro, as we may have completed a second leg of a downswing if we draw a projection from high to low of 2 weeks ago and we move it to our most recent high. We could see that we sort of completed that second leg, so we may be just seeing some consolidation prior to another move down. We, in that 1 hour, haven't even moved to the 50 period moving average so far. For a fuller technical view, please visit FXTimes.com for today's technical analysis video update. For the Eurozone, we do have some important fundamentals coming out overnight, which we will look at the end of today's broadcast. In a look at one of our growth-linked and commodity-linked currency pairs, the Australian dollar-Japanese yen pair, we see the decline to start this week as we fell from the 81.80 area to open down to the 80 level during the Asian session. After a rebound in European trading, which saw stocks, like I said, mostly positive for the session, the pair cut its earlier losses, only to give them back again in the New York session. So we had a pretty choppy and whipsawy sort of day in terms of risk sentiment. Zooming this pair out, we do see, however, that we've moved below our levels that we had seen last week, and we move closer to test the lows that we had seen during May 6th, when we had a very sharp plunge in risk sentiment and unwinding of carry trade positions. New Zealand dollar US dollar pair also opened, moving in favor of the greenback, which is a risk aversion trade, and after consolidating around the 0.70 area, we dropped further in the early New York session. So we hit a support all the way at 0.6914, which moved us below our lows from 2 weeks ago, and it's the lowest this pair has been since the middle of March, early March. This price action may reflect a growing concern that the debt worries in the Eurozone may work to short-circuit the overall global recovery. While the moves were not as strong as we saw with the New Zealand US dollar pair, the US dollar Canadian dollar played out a similar situation as we saw with the Aussie US dollar pair, as we had first a move in favor of the greenback as we extended our gains from Friday's session until we hit the 1.0437 level. Then we paired those gains, and again we had moved back and forth in terms of risk sentiment. Here we saw crude oil hit a 5-month low, which will work against the Canadian dollar if we continue to see weakening oil prices. Zooming this pair out and applying a Fibonacci retracement to our most recent down move, we see that today's high was also a 50% retracement of this downswing. We'll see how this pair reacts once it moves up against its moving averages, and we test our support from earlier today at 1.0315. While the situation is not as complex as we have in the Eurozone, the fiscal situation in the UK is shaky. The incoming Chief Secretary at the UK Treasury found a note last week from his predecessor that read, "Dear Chief Secretary, I'm afraid to tell you there's no money left." The UK is facing a high debt to GDP ratio and a high budget deficit, and while cutting the deficit is an important priority for the incoming government, it's dubious to see how much they can accomplish in a short time. They have called so far for £6 billion in cuts. The pound-dollar pair opened this week, sliding sharply, falling below the 1.45 level, and we hit a low at 1.4250. Since there, the pair did manage to correct its earlier decline using the 1.45 level now as resistance. We're also coming up against the 50-period moving average in the 1-hour time frame. Similar to what we had seen with the euro pair, we moved below our lows here from 2 weeks ago from May 7th. That put this pair at its lowest since March of 2009. We saw 2 weeks ago in the pound-yen pair a very strong unwinding of carry trade positions, and that continued in mid to late last week and in today's session as we moved all the way down to 131.07 as today's support. So that means we didn't go and test the May 6th low, but any increase of risk aversion in the coming week should push this pair down as traders continue to unwind riskier assets such as pound-yen carry trade. So that should cover all of our main market highlights. So let's take a look at a couple of fundamental releases from the US. In today's trading, we saw US Treasury prices rise as yields fell in today's risk-averse environment. We also had a report come out from the Treasury which measures net foreign purchases of long-term US securities, and the net foreign purchases amounted to a record high of $140.5 billion in March, up from $47.1 billion in February, as there was very strong demand for treasuries. China, Japan, and the UK all increased their amount of treasuries, and there was a net total foreign purchases of treasuries amounting to $108.5 billion in March. Treasury bonds rose last week as investors sought the safe haven status of treasuries and fled riskier assets. However, that shift into treasuries could be limited or even swing the other way as investors pay more attention to the massive U.S. deficits and look for bonds from countries in a better fiscal position in which to seek a safe haven. So it may take a couple more months for the data to catch up to recent events, as this is for the March period, but we'll continue to monitor if there is a drop-off in demand for net long-term U.S. assets. In a second report, we had a reading on manufacturing in the New York region, which expanded at a slower pace in May than forecast as we had sales cool. Today's report indicates manufacturing is settling into a more sustainable pace of growth after helping pull the economy from its worst recession since the 1930s. The index, the Empire Manufacturing Index, registered a 19.1 reading from 31.8 in April. Factories in the area did boost payrolls at the fastest pace in 6 years, which show that they will probably keep expanding as consumer purchases strengthen, businesses rebuild inventories, and exports pick up. Now let's take a look at some upcoming fundamental releases. Tonight, New Zealand posts its producer prices, Japan releases a measure of services activity, and Australia releases its meeting minutes. Overnight, Japan posts a measure of household confidence, the UK releases inflation figures, and we get 3 relatively important releases from the Eurozone, including Germany's ZEW economic sentiment, the final version of consumer prices for the month of April, and the trade balance